Hello Sector Watchers, welcome to the show. This is the 160th episode of Sector Spotlight for Tuesday the 24th of January, and I'm recording it on Monday the 23rd. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. This episode of Sector Spotlight is all about plotting market breadth on relative rotation graphs and what we can learn from it in relation to the broader market performance. Ladies and gentlemen, this is Sector Spotlight. Recently I'm seeing quite a few articles and videos on market breadth and how that is working in relation to the market and whether it's being supportive for a further market rise or not. And as usual, there's always two sides to the equation, and some of the people are using it as an argument for the markets to rise, and others are not so sure. So I need to tell you that I'm by no means a super expert on breadth, but I like to use it as a, secondary kind of keep your eye on what's going on, big picture type thing. I think that's what drives me, and trying to get the bigger picture in some charting format. And turning it to relative rotation graphs and RRG and trying to put all that together. A while ago I've actually written a few articles on that in the past, which links I will put in the comments or in the description of the video. And I've come actually to two ways I think that RRGs can be used to measure breadth. And the first way is using a special breed of indices that we have here on StockCharts.com. And we calculate a number of indices for markets like the S&P 500, but also for all the individual sectors, that calculates the percentage of stocks above a certain exponential moving average value. And there's three sets. So there's the 20-day, so percentage of stocks above 20-day moving average, exponential moving average, percentage of stocks above the 50-day exponential moving average, and the percentage of stocks above the 200-day exponential moving average. And on this chart here, I've plotted the S&P 500. And although it's tempting, if you want to go back longer and look at those indices on daily or weekly and monthly scales, it is possible. But for some reason, I like to stick with apples and apples. So we're calculating a daily moving average. So it kind of makes sense to use a daily chart with that. So here's the S&P 500 going back to somewhere at the end, Q4 2019. And below it are those three sets. So the first one here is the percentage of stocks inside the S&P 500 that are trading above their 20-day exponential moving average. This is the 50-day and this is the 200-day. And if you got one thing is super important to realize here is that those values are restrained between 0 and 100. It's a percentage, so it can't go above 100, can't go below 0. And that's something that you need to be aware of when you look at that, especially when we start looking at RRGs. And what you can also see here is that it's very, first of all, this is the S&P 500. And what you can see here, that almost never, very rarely, maybe never, those values reach 100. So almost never all 500 stocks are trading above their 20, 50, 200-day moving average. So that's one thing, which tells me that there is always movement going on. There's always some sort of a rotation going on. That's one thing. The second thing is that the periods that these lines remain at elevated or suppressed levels are relatively short. So they roll over and they make moves. And then obviously the 50% is, maybe 50% is something that you want to look at. And here is a good example of where this is the 200 days. So this is the longest time frame. And obviously, so when this number of stocks continues to push, or the number of stocks that push above their 200-day moving average is growing and growing and growing, and that's driving that market higher. But then it peaks in April 2021. And then while the market continues to rise, you see that the number of stocks that's trading above their 200-day moving average, and as a matter of fact also the 50 and the 20-day, is declining. And that is something, that's the stuff that I like to see, because it tells you that something is going on under the hood. And maybe you remember, this is also the period where, when I started looking at relative rotation graphs, that was the time where the defensive sectors were super strong and they were leading the market. And that was something that you didn't expect in a bull market where defensive sectors were leading, and that was exactly here. And that was happening in the breadth, under the hood. Things were changing and things were shifting. And that reminds me of a quote that the first time I heard it was from Greg Morris, who you may know as an author here on the site. And the quote is that breadth always arrives at the party on time, but leaves early. And that's exactly what you see here. It's on time, it starts to move, and it picks up that bottom and moves all the way up. And then, while the party is still going on, breadth starts to leave. Breadth leaves early. So I think that is a great quote that you should keep in mind. But I later learned that Greg also stole it or heard it. He actually attributed it to Tom McClellan, who's also an author here on the site. Apparently he's the one, I didn't go any further. Maybe Tom also picked it up somewhere. But those are the two people I know have used that phrase. And I like it. I think it's absolutely true. And so when we look at these lines, we got to keep in mind that first of all, doing a trend following analysis on something that is range bound is difficult. So that's one thing. And obviously RRG is a trend following tool. But I think there is a way that we can actually use it to our advantage. Because this is the S&P 500, but we also have those data for the individual sectors. So calculating those values for individual sectors. And what I then did is I started plotting those indexes, those indices on an RRG. And this is the version looking at the 200-day, the set of the 200-day EMA, which you see here. And the benchmark, also very important, is the same index, but now for the S&P 500. So we can see the relative movement of those indices versus the S&P 500. And where we normally would look and sort on the percentage change, I think here, and it took me a bit of time to actually pick that up, I think here sorting on price is maybe the better way to rank it and look at it. Because it's range bound, it goes from 0 to 100, and you can see that here in the energy sector, 87% of the stocks are trading above their 200-day moving average. But you can see that the tail is inside the lagging quadrant, and over the last 5 days, 5%, that 86 coming down from 5% higher, so that's probably somewhere early 90s. So while this is still at a high value, on a relative basis, it's already starting to come down, which means that it's probably rolling over. If you go to the bottom side, you can look at communication services. only 32% of those stocks are trading above their 200-day moving average. And over the last 5 days, 20% of those stocks moved lower, so moved below their 200-day moving average. That percentage moved lower. Obviously, it depends a lot on how many stocks are inside an index, but so take it loosely, take it as a sort of I don't know, warning light, warning sign, but you can pick up some ideas about where that rotation is going, especially when you compare it to the S&P 500, which has only 60% of the stocks above the 200-day moving average, by the way. If we then go to the 50-day, so we move lower in the time frame, then we can see that there is a group that is moving lower on that RS ratio scale. So they're actually trending lower, because I hope I can explain that correctly, but when you're looking at trends, obviously when something is moving from 0 to 100, that is a very nice trend, and any type of indicator will pick that up. When you hit a plateau, let's say ideally 100, but we've seen that rarely ever happens. It happens in the individual sectors, but not in the S&P 500 itself. And you start to level off, that's where the RRG comes in. But the first thing that you will see is that momentum will roll over, because when the closer you get to that 100 level, the more difficult it will be for that sector to actually push further, to get more stocks above the 200-day moving average or the 50-day moving average, because almost all are above it. So when it's then a very strong trend and all these stocks remain, so the sector remains at that high level, that momentum will drop off, because if you have a flat line at 100, the momentum will be 0. No matter, you can have look back periods, whatever, but the momentum will eventually be 0. And the same will be for a trend, because when it moves sideways, there is no trend anymore. So out of every trend following indicator, trend following system will start to say, hey, there's no trend anymore. So for that purpose, this approach with those percentages above and below, above the exponential moving average is not too good when they are very strong. But what they will pick up is when they start to turn. So when you see the percentage of stocks rolling over and starting to move down, whether that's a 20, a 50, or a 200-day exponential moving average, that's what you will pick up when you plot these indices on an RRG. And here is the 20-day version. And you can see that on the lower part, they're starting to pick up a little bit. And on the high end, they are rolling over, and the yellows are all rapidly losing momentum. Now, the next step that you can take is you can actually use the same set of universes, but plot them against $1. So now we're looking at the trends per se, so not necessarily against the S&P 500, but we want to see if all those lines for all those sectors are either going up or are going down. And what you can see here is that in the S&P 500, obviously we had a very nice run, but if everything is still honky-dory and going up right, you would see strong RRG headings on all these tails. They would all move into that northeastern direction. And there are very few here that are still doing that. The energy sector here is kind of still one of them. Healthcare is sort of doing it. And what's this one here? That's technology. That's also kind of picking up. But that's about it. All these others are starting to lose relative momentum, which means that they're sort of starting to roll over. And if we do that for the 50-day, then it becomes even more clear. You can see that they're all kind of rolling over. And if you do that for the 20-day, then you can see that it looks as if under the hood, that current rally is starting to hit a plateau in terms of percentage of stocks that are above their moving averages. Now, this is, as I said, I invite everybody to look at this and tell me what they find, but the way I look at it is that this set of indices on an RRG will help you to potentially signal turnarounds. So a turnaround in breadth when all these stocks start to move. So you need to, when there is a move in either direction, up or down, that will show. When it is very strong and it remains there, you will see something that moves, everything moves to the middle because they will all get to that benchmark. And that, I mean, I haven't seen it a lot, but that is what I can sort of think of what would happen in case that would be a very long, strong trend. And well, going back, I haven't seen much of that. Now, the second way of using RRGs for breadth is a little bit different. Here in this second approach, we take a little bit different angle because here we're going to use the RRGs on price, so not on the indices, but on outright price, and compare them to $1. And I know that a lot of people who are watching Sector Spotlight like to do that because it gives them a feel for absolute price development. And especially if you're a retail investor, then who cares about relative strength? You need to make money and you need your portfolio to go up. So there is no better benchmark than the flat line, so no loss. And if you do that, and again, we can do that for all sectors, but let's start. So I've set up 12 tabs here with 12 relative rotation graphs. And the first one is for the sectors, and then we go into the 11 sectors. So here you can see how you can actually very well see the strength, the recent strength, where pretty much everything's on the right except for a few things. So here's technology that's rolling over, real estate, utilities coming down, and the one here in the lagging is consumer discretionary, no surprise. Energy is still very strong, but they're all losing momentum. So all these uptrends are now rolling over. And of course, there is a possibility that they will, roll over and go back up. But these are weekly RRGs. So it will take some time before that's happening, before that new lag in that uptrend's going. And yes, I do know that the S&P is pushing against that falling trend line, and I'm watching it like a hawk. It's actually very interesting to see what's going on. As a side note, there is the dispersion between performances in sectors is so big. There is not it's not one big move. There's people who say there is a bull market here and whatever. Yes, there is, but the market at the S&P is still in that falling channel. So there are so many discrepancies all over the place. We talked about the sector rotation model last week. That wasn't very aligned. And that, to a degree, that also is a market that's telling us that it doesn't really know where it should be heading. Which, by the way, surprises me that the VIX is below 20, which is kind of something that you would expect in an environment with a very stable trend, and that's also not the case. So there's a lot going on. So looking at breadth kind of makes sense for this week. Now, this is for the sectors, and you can see there's actually not one, well, here, communication services, barely. There's one sector out of 11 that is at a positive RRG heading in terms of absolute trend. That's something that we need to be aware of. All these others are losing momentum, and the trends are, everything on the right is still in an uptrend, everything on the left is in a downtrend, but the uptrends are losing momentum. Not the end of the world, but definitely something to be aware of. Now let's go over each and every individual sector, where I've plotted the individual stocks of that sector against $1. And if we go over these, that will give us a sense of how many stocks, so not as we discussed, number of stocks above a certain moving average, but here we use the RRG algorithms to determine whether there is a trend against the benchmark. Happen to be that the benchmark in this case is $1, so it's a flat line. Nevertheless, using this type of visualization, we can see how that universe is moving. And while I'm telling you this and moving my hands around, I need to think about these big swarms of, I think it's swallows or sparrows, where you can see they're moving through the sky, and you can see, but they're spread out, but they all move in a certain direction. They make beautiful patterns. And you can compare these RRGs with that. They move in, all these stocks move in swarms, and they move together, and kind of give you an idea about the general direction for that sector. So here is communication services, and that's actually not looking too bad. A lot of the blue ones are all at a strong RRG heading. A few are rolling over. These were the first waves, and they're now handing over to this bunch in blue. There's only one in red, that's EA. But I think you agree with me that the majority of stocks actually doesn't look too bad. Now, if we go to the second one here, that is consumer discretionary, that's a bit of a different story. You can see that all these are rolling over and starting to move at a negative heading. So we got Amazon and Tesla finally picking up a little bit, but just look at it. Look at this chart, and what is the first thing that comes to mind? I believe it's like, oh, all these green ones are rolling over and they're moving down, and there's a few yellow ones already. There's not much going in the right direction. Here, a few in the blue, but that's it. So this is not a fantastic. If you look at breadth for consumer discretionary, this is not telling you a fantastic story. Here you go to consumer staples. Same. Majority is rolling over. You see a lot of negative headings here, and the few that are in the green and are good are already starting to lose momentum. That's not very good. That's not a strong. This sector is not driven by the broader markets, not a broader component going higher. Look at this here. This is energy. This is rolling over. This has been a very strong trend. We all know energy has been super strong, but in terms of price, a lot of them are now rolling, all these uptrends are now rolling over in that sector. So here is financials. This is a bit out of whack because of that long one here. So what I then try to do is I find that one and tick it off and then fit it again. And now we can see what's going on broad-based in this sector. All of them are rolling over. FRC is not. There's one here, TF something, CME. But that's about it. The majority of those sectors, they're losing momentum. I hope you agree with me that this is not. We're still thinking in terms of breadth. This is all rolling. These trends are done. They're at least going through a pause. These are not full-fledged uptrends. Here's another one. Here's healthcare. Again, CTLT. Let's take that away because that is an outlier. Take it away. Fit. This is kind of mixed. Here's a few that are really good, but there's also a few that are really bad. So to me, this is a neutral. This is like a sector that is neutral on breadth. That's kind of 50-50, maybe a little bit more negative, but this is actually not too bad of a sector when you look in terms of market participation to the upside. Here is industrials. Again, look at that. There's a handful here. This one is LHX is moving rapidly into lagging. FDX seems to be rolling over, but look at all of this. All these green and yellow ones, they're all at negative headings. That means this is looking at price trends. These are all finding resistance, rolling over, losing momentum. Still in uptrends, for sure, but at least in a pause, if not turning around. Here is materials, same story. That was a very good sector. Everything is on the right. These are all uptrends. But they're now all starting to lose momentum, and a few are leading the way down. MOS, CF, ALB, CTVA, they're all, this is going into a pause. The majority is on the right. So that's for most of these sectors, and that's not surprisingly given the rally that we've seen. But it looks, if I just look at all these RRGs, it looks as if those rallies in those individual sectors are getting tired. And when these sectors are getting tired, the S&P, I think, is getting tired. Isn't showing it right now because I'm looking at my screen here and up 1.2% again, so we're really challenging that falling trend line. But hey, this is what I see. I've learned to actually not talk about what I wish I would be seeing, but what I'm actually seeing. So here is real estate. Again, mixed, but all these tails are curling over. All these tails are rolling over to a negative heading. So no matter how nice and how strong that trend is, although it's not that strong because there's still a lot in a negative trend, but they're losing momentum. All these stocks are losing momentum. Here is one that is, technology is actually, it's actually one of the strongest sectors if you look at market participation and breadth, because just like it was healthcare that was also kind of spread out and not everything moving in the same direction. There's quite a few nice tails here in the green and in the blue, and there's also a set that's moving the other way. So it's spread, it's split, but it's not super negative and moving in one direction. And then finally here we have utilities, and that's also an interesting one because look at the outliers here. So we're going to take those away. So we're going to take away NRG, and we're going to take away AES and CAG, and D, that's also one that's an outlier. So now fit it. There you go. Look at that. So all these utility stocks, although they're in uptrends, they're looking nicely, but they're running into a problem. They're running into a pause. So I need to wrap this up. But given all these sectors, and you can actually, when you have all these tabs open, Control Tab walks you through it, and that's the way I like to do it. I'm finishing off with that. So you go like, this is okay, not okay, not so good, not so good, not so good. Spread out, evenly spread, not so good, not so good. Leaning towards not so good. This is spread out, kind of okay, rolling over. And if you do it like that and you go very quickly, then I think you've agreed with me that these are, there is at least, I think, at least a pause coming our way, unless something really, really rapidly is going to change in coming weeks. So from a market breadth perspective, looking at RRG, I am still quite reluctant to go all in and bet the farm, in my case, on the S&P 500 going higher straight away. And that's it. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on StockCharts television. I'm looking forward to seeing you again next week for a new episode of Sector Spotlight. Same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.